On overnights,
I believe in reason and common sense.
Leith Van Onselen from Macro Business with the Treasury of Common Sense.
Common sense never goes out of style.
Well, that's what the funny little man would like you to believe. However, let's get some real comment here from Leith Van Onselen. Morning, Leith. How are you?
Yeah, g'day, Mike. Thanks for having me on again.
You're always welcome. Monthly inflation indicator. What do you think we really learned from that?
Yeah, so it was actually good news again. So basically, the Australian Bureau of Statistics on Wednesday released its monthly inflation indicator. Now, this isn't its main quarterly inflation, CPI inflation release. It's like an intra-quarterly release that it does every month, and it's basically designed to. It's not as robust as the quarterly. It's not as detailed, but it's basically designed to give you a gauge of where inflation is heading between the quarters. So we received the result for January, and it was more good news. CPI inflation, according to this indicator, fell by 1/3% in January to be 3.4% higher year on year. Now, that was below the economists' and markets' expectation of a 3.6% annual rise. So it beat that. It was below that by 0.2%. And it's also slightly below the RBA's forecast that they put out. And also underlying inflation. So that's basically when you strip out the volatile items, slowed to 3.8% annual in January, which was also below the RBA's forecast. Not by a lot, but it was below. So the good news for this is that basically inflation, just like the quarterly inflation did, the monthly inflation is falling faster than what the RBA had in their forecast. And basically what it means is, all other things equal, it basically increases the likelihood that the Reserve Bank will obviously keep rates on hold, but not just keep rates on hold. If it keeps going in this direction, it'll cut rates later in the year, which is basically my expectation in the second half. So it was just basically another good print if you're a mortgage holder and you're sick of these higher interest rates and you want to see interest rates come down.
So good news, not sensational good news, but good news going in the right direction. That's about it, isn't it? Yeah,
that's it. I mean, it's certainly not, pop the champagne corks, and I don't think it's going to make any difference to what the RBA will do at the next monetary meeting, which, for all intents and purposes, will be another hold decision. It will need some very, very strong data to come out between now and then for it to hike rates. But, at the same time, inflation is going in the right direction. So it's and it seems to be falling. If you based on the quarterly, based on the monthly, it's falling quicker than they expected. And the next key piece of data, Mike, will be early next month. Next week, I should say. The December quarter national accounts will get released. So that's basically where you get Australia's GDP growth and all the other main indicators. Now, that's coming out for the December quarter. It's obviously very lagged because we get that, well over 2 months after the period we're looking at. But that's expected to come in very weak. And, there's sort of an outside chance that Australia's economy might have be on the way to slipping into a technical recession, which is when GDP starts going backwards. It's got to do that for 2 consecutive quarters to be labelled a recession. So some economists think that we'll get a negative print. Once you adjust for Australia's insanely high population growth, it's guaranteed that Australia will go into a fourth quarter in a row of negative per capita growth.
Yep.
So basically that's, as I explain every week, that's when the economy's growing, but it's not growing fast enough to keep up with population growth. So we're going to get another quarter of that. And if that comes in weaker than the Reserve Bank expected, it's just another one of these negative indicators on top of a whole bunch of other negative indicators to suggest that that monetary policy is potentially too tight and that the Reserve Bank should cut interest rates. And the key one to look at is that, and then also we'll have, a week or so later, we'll have the February labour market report, which is where you get your unemployment rate and things like that. And the Reserve Bank most recent forecasts say that Australia's unemployment rate is going to go to 4.3% by the end of the year. We're already at 4.1%. So we've got 11 months to go, and we're very close to its forecast. So if that continues to deteriorate, well, that's another reason why the Reserve Bank's likely to cut interest rates, because basically the economy is slowing faster than all its projections, and inflation's coming down faster than it projected so far, based on the data.
Now, given that we have these conversations on a weekly basis, when I saw this headline, I was curious as to what your reaction would be, Leith. This is Treasury saying that wage growth was driving inflation. So what do you got to say about that one?
I think Treasury's started taking drugs, Mark, taking some sort of alternative reality drug.
Yeah.
So, mate, like you, I read this analysis from the AFR and I just thought this was absolutely insane. So basically what the Treasury is trying to argue is that since the June quarter last year, so since mid last year, Australia's inflation has been driven by wage growth. Let me just say, I cannot disagree with this analysis more. So Australia's wages, so we got the December quarter wage price index, which is the wage growth figures, only about 2 weeks ago. And what it showed is that wages only grew by 0.1% more than headline inflation last calendar year. And it grew exactly in line with underlying inflation. So that's once you take out the volatile items. So Treasury's trying to claim that we've had basically zero real wage growth last year. And actually it's negative once you adjust for bracket creep, and because people's taxes go up as your wages go up, because you get pushed into higher average tax rates. They're trying to claim that that's driving inflation. And there's an important point to make here. Like Australian wage growth amongst the absolute slowest in the world. So this is before you adjust for inflation. Our wage growth is tracking below the US, below the UK, below the Eurozone. Real wages have fallen to around 2010 levels over the past few years after falling nearly 7% from their peak. So Australian wages, once you adjust for inflation, are tracking back where they were in about 2010. And also wages are growing a lot more slowly than the cost of living for working households. So the Australian Bureau of Statistics earlier this month released its cost of living index, and it showed that if you're a working household, your cost of living on average went up 6.9% in 2023 against wage growth of 4.2%. Now, it just seems patently ridiculous for the Australian Treasury to claim that wages are driving inflation when, in real terms, they've plunged nearly 7% from their peak. They're tracking at 2010 levels. They went backwards last year, didn't keep up with the cost of living. And once you adjust for taxes, didn't even keep up for inflation. Yet here's the Treasury, which is supposed to be one of our preeminent public sector economic organisations, trying to tell us that now wages are driving inflation. It just doesn't pass the pub test, Mike.
It does not indeed. Leith, appreciate your time and comments as always. Thank you very much for that.
Yeah, cheers, Mike. Speak to you next week.
Leith.